it's really in our focus. The New York Community Bank Corp, the lender, was cut by Moody's less than a week after slashing the payouts and stockpiling reserves, putting more concern about the commercial real estate market in our mind's eye. Abigail Doolittle has the carry through on Moody's cut.
Yeah, a lot of wild trading here. So after that downgrade, and that of course was after yesterday when the stock was at its lowest level since 1997, basically down 60% since reporting last week when they talked about building their reserves 12 times over what was expected, 12 times over expected to potentially cover for bad real estate loans, commercial real estate loans. The stock down 60%, trying to catch a falling knife. Investors really not doing a good job. Then that Moody's cut yesterday, and then today the company coming out perhaps trying to reassure investors, saying that bank deposits actually climbed, that total liquidity of $37.3 billion exceeded uninsured deposits of about $22.9 billion. Total deposits of $83 billion represent an increase from the end of last year. So when this news initially came out this morning in the pre-market, as you know, Manus, the stock had been up about 18%. Not so long ago, it was down about 5%. Right now, up about 1%. Investors really don't know. They just don't know how severe that exposure is to commercial real estate in terms of office and multifamily. From a chart perspective, as I mentioned, it is truly trying to catch a falling knife, a difficult way to invest. It may take quite some time for these shares to stabilize.
Abby, thank you very much. A lot of put option buying on that stock yesterday, going for management changes. Let's flick across to Snap. The stock is falling. It's struggling. It's struggling in the ad market. There's a slump there, disappointing on the revenue side in the holiday season. Ed Ludlow has the dissection. So Ed, this comes down to where do you spend your ad dollars, on Instagram or Snap?
Not on Snap. I mean, they had top-line growth of 5% to $1.36 billion. The street was looking for $1.38 billion, so a small miss. The stock's down almost 32%, which puts it on track for its biggest decline since October 2022. But the context here is like Snap has done this big reshuffle within its business. Even as recently as Monday, they announced more layoffs. But if you look at the bottom line, they had an adjusted EBIT loss of $55 million to $95 million. So part of this is the street saying, well, you've been rethinking your ad platform over the last 12 months. You've taken the painful decision to do layoffs already in the last 12 months. You're doing more. That's not showing up in the bottom line either. Overall, active users grew 10%, but they grew in those core markets like North America and Western Europe. The problem is the story for Snap's been the opposite. They put a lot of time and money over the last couple of years saying we're going after emerging markets because we think we can grow the user base there and we think we can get ad pricing power there as well. That's not worked, and now they're pivoting back. But it's a pretty big move, 30% on what's already a pretty shrunk company, Manus. I don't know if you're still on Snap these days, but you're completely right. In the fight for eyeballs, the money ain't going to Snap.
Oh, Ed, I'm feeding that many platforms at the moment. Apparently did quite well on corporate TikTok, so I'm gonna adopt that on a personal basis now. Apparently so. Rumor has it in the newsroom. Ed, thank you very much. Ed Ludlow, who would have thought I could be big on TikTok? Talking about bonds, desperate times. Let's talk about automakers. Ford beats on expectations. You got new forecasts, higher profits to come in 2024. You got it, due to EV losses and labor costs. So there's big issues to deal with, Isabel Leonda.
There are big issues, but for now, investors are cheering the report. We're seeing the stock up around 7.5%. That's on track to reach a 6-month high. The company posted adjusted EPS of 29 cents. That's more than double analysts expected. And fourth quarter revenue also came in at $46 billion. That's also well above estimates. We have CEO Jim Farley saying we are nowhere near our earnings potential. And to your point, there are big issues. This includes EV sales are slowing, and this seems to be a theme now. Yesterday we had a Hertz reporting, and they also mentioned that same issue. And this forces companies to be more nimble. So Ford, for instance, is looking to balance scaling back their EV production while also dialing up output of their traditional industrial combustion engine models. And Ford is also looking to develop smaller, cheaper EV vehicles. That's to compete with Chinese models and also Tesla. And a bright spot, though, is hybrid gas EVs. Ford expects those sales to grow 40%. For 2024, Ford expects earnings of $10 billion to $12 billion. That's on the higher end of their November target. And automaker is giving investors a supplemental dividend of 18 cents a share. That's on top of the 15 cents regular quarterly dividend. Manus.
Well, it's bid up this morning, up 6% as well. Thank you very much. Let's turn to the ride-sharing space now. Uber reported gross bookings that beat estimates, showing strong global demand for rides and food delivery. Katie Greifeld has the latest. Katie.
Yeah, man, it turns out people are still hailing rides and also ordering food. You take a look at gross bookings. That clocked in at $37.6 billion in the quarter ended at the end of last year. Analysts had been expecting $37.1 billion on average, so a beat there. For the current period, also a rosy outlook there, forecasting bookings between $37 billion to $38.5 billion. The midpoint of that range slightly above the average estimate of $37.3 billion. You also had Uber CEO taking a bit of a victory lap, saying, quote, it was a standout quarter to cap off a standout year, but shareholders not as impressed right now. You can see the stock is currently down almost 2%, and that's simply because the bar was so high. Uber shares have just about doubled over the past year. They hit a record high in the run-up to these results, and they have also crushed their biggest rival, Lyft. But looking forward, the company did say that it's going to proceed with an earlier pledge to return capital to shareholders. It's going to provide more details on those plans at an investor event next week. So stay tuned, Manus.
Okay. Now that I've arrived in New York, I just added to the Uber gross margin and gross revenue. Katie, thank you very much. Well, Morgan Stanley's Andrew Slimman looks into what to expect for this year. Breadth is narrowing. To me, the market is looking tired, and that alone is a reason to be more cautious. However, I don't expect more of a correction until later in the year. Good to see you this morning, Andrew. Cautious. What does cautious equate to in terms of action? What level or gravity of caution do you have? Good morning.
Good morning. Yeah, look, I mean, the market has rallied 20% off the October low. It's been up 13 out of 14 weeks. And I think the market and the breadth is narrowing. It's a sign of the market tiring. So maybe when we hit 5,000, which is right around the corner, that the market takes a breather. Could we get, a 5 to 10% correction off that level? I think it's possible, but I expect more of a pullback later in the year, because I don't see kind of the fundamental framework to cause a bigger pullback right now than just we've had a very good run, and investors might be looking to cash in a little bit.
Now look, I mean, it's an old saying, a man that tires of London is tired of life, but a man that tires of big tech must surely be challenged. Now, you're not exactly tiring on big tech, but you are still, very strongly biased towards the Microsoft, the Apple, the Alpha. I was looking at your fund.
Sure.
Are there, if you were to take a traffic light system to that, where are you? Still full green, quasi-amber, but certainly not red?
Yeah, I mean, I think it's important to take a step back. I mean, what drives stocks is earnings and earnings revisions. That's the important thing. Where are the positive revisions coming? And boy, oh boy, they're coming in a lot of different industries right now. And one of them is in tech. Now, as we all, lots been, discussed, it's no longer the Magnificent Seven. There is bifurcation going on, but largely these companies continue to report excellent quarters, generating a lot of cash flow. So I don't think it makes sense to, sell them and look elsewhere. I think it's been a mistake until companies really express more cautious, and we're just not seeing it. So my correction is maybe trade, take a little bit off these positions, but I think they'll be higher by year end.
When you look at so much of this risk, proclivity for risk, we started with one of the worst years for risk across assets since like the late 1990s. Here we are, we're a month into 2024. When you stand back and you look at risk, do you just incrementally deploy because to fight this momentum in the market is perhaps folly?
Yeah, no, well, it depends. I mean, it depends really what the time frame that you're talking. Look,
okay.
The time I was very convinced, and I articulated on these shows, that the market was going to rally in the fourth quarter, because it takes a year of investors selling off the low until they flip and they start buying. And that's always been the case. And last year, the bears, kept fighting it. People kept selling. The market rallied because companies were buying back stock, and they flipped in the fourth quarter. So it was a time to add a lot of risk, was really going into October of last year on a short-term basis. I think now it is a time to be short-term cautious on risk. So I would look at the high beta stocks that have done very well and maybe take some money out of them. But to your question, look, investors only started buying into the market in the fourth quarter, in my belief, and that's going to continue this year. Sentiment is going to, cash is going to follow sentiment, and I think it's going to be a good year for markets. But you have to be more, respectful of the fact that last year there was very little volatility in the market. The VIX stayed, very low. Markets went up 8 out of 12 months. There were a lot of people screaming it wasn't going to happen, but the market pretty much went straight up. And so I think, reversion to the mean means more volatility this year.
Tell me,
the bears will have a better day at times, but it will be a higher by year end.
Look, I'm just looking at the headline that we just popped on NYCB. This isn't to dig into the story on NYCB. This is to dig into the conversations. To what extent are people talking about this in your shop and on the street? What is the market saying, Andrew, about NYCB and the idiosyncratic nature of it, the New York nature of it? Can it be a spoiler? Can it be a grey swan that morphs into something? The German stocks are under pressure, Japanese stocks are under pressure, the New York stock is under pressure. This is idiosyncratic or something a little bit more humorous?
Very good question. But if you ask me what the market is saying, the market is saying it's idiosyncratic because the market's hitting it all. It's close to 5,000.
Do you doubt that?
The market.
You've lived through a few cycles with me. Do you doubt that?
Absolutely. I think there are reasons to actually be optimistic on financials. I'm just not sure of the regionals. I know that there's going to be more volatility. This year. That I'm confident. Could this cause more volatility? Yes. Is this going to cause a systemic problem throughout financials? I do not believe so. But, again, I know there's going to be more volatility. You tell me what's going to cause it. Could this be it? Sure.
You probably quite like the volatility. I'm curious, I know that you can talk about Microsoft specifically. I mean, Satya Nadella puts his anchor down on India. It's gone to a $3 trillion market valuation under him. And again, he talks about the AI opportunities. Does its magnificence just shine within the Mag 7?
Well, I mean, maybe I'm just not that, as tech savvy, but I can understand the Microsoft story, which is, you have Windows, you want Copilot, it's going to cost you more. And the estimates for this year and next year in terms of the absorption of Copilot is relatively muted. And I think it's going to be rolled out much more. They're very quiet right now in terms of actual numbers. As the year progresses, I think we're going to learn. It's more, more people are using Copilot than are currently in the estimate. So that's a reason to stay long that. But I think there are plenty of value areas, industrials, in financials, in the market for opportunity. So I like a balance between growth and value stocks this year.
I'll leave you with this thought from Nadella. Okay. I have never seen a rate of diffusion of any technology like this in the 70-year-long computer age. We all need to go back and read Greenspan's speech on paradigm shifts in technology. Putting it out there. Andrew, thank you very much. Andrew Sliman there of Morgan Stanley on the calls in the market. Coming up, President Biden plays the blame game.
Now, all indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump.
The bipartisan bill on the border security and aid for Ukraine set to fail. The conversation with Amy Hordan.
The result of all this hard work is a bipartisan agreement that represents the most fair, humane reforms in our immigration system in a long time, and the toughest set of reforms to secure the border ever. Now, all indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump. Because Donald Trump thinks it's bad for him politically.
The latest U.S. border deal on the brink of collapse. President Biden there placing the blame squarely on the Republican presidential frontrunner Donald Trump. Biden says that Trump pressured members of the GOP to reject the bipartisan immigration bill that included aid for Ukraine. Amory Hordan has been tracking this. It's a bit of a high-risk strategy, isn't it, for this blame game straight off the pulpit. But where are we in this? I mean, this bill is all but dead.
All but dead. There'll be a vote today, and it's likely to fail. And then what Senator Schumer is likely going to do, according to our reporting and some other reports out there, is going to put basically test the waters with another motion on the floor to see if he can get the aid through for Ukraine, Israel,
that would be a clean
and Taiwan.
bill.
It wouldn't include the border. But the issue is, if this is able to pass in the Senate, which the Democrats have control, and there are a lot of also defense hawks in the Senate that want to see aid to Ukraine, want to see aid to Israel, want to see aid to American partners in the Indo-Pacific, if it's able to pass in the Senate, there's still a question of whether or not this could pass through the House of Representatives, and Speaker Johnson could put this on the floor. The Republicans have really come out in the past few months and said no more aid to, say, Ukraine without fixing the U.S. southern border. And now it looks like these two issues have to be delinked because Republicans in the Senate do not like this current border deal that you just heard the president talk about. And he's saying that if that doesn't pass, which it's not going to, he will make it an election issue. It's funny because they both want to make immigration election issue.
Can this country run for another 6-7 months with I'm not saying an open border, I'm just saying a less
overwhelmed border.
An overwhelmed border. Thank you for helping me. But in the end of the day, 6 out of the 10 swing states put the blame at Biden's door for this migrant crisis. He needs a fix.
Well, this is why the former president, Donald Trump, said this would be a gift to Democrats. He's looking at the same polling we are. The latest NBC News poll over the weekend showed there's a 30-point margin to Trump's favor when it comes to who would be better when it comes to immigration and the southern border. I was really taken with the fact that the border union, the southern border, who endorsed former President Donald Trump, says this is a good deal and they should put it on the floor and they should vote for it. This is where it becomes a little bit of policy versus politics.
Of course. Well, that's the same in every capital in the world. Talk to me about Haley in Nevada. I mean, she scored less than tick the box for none of the above candidates.
Right, Nevada's
What does that mean? You're going to say, is it idiosyncratic and I shouldn't get too heated up about it?
No, I mean, Nikki Haley has a really, really steep path forward. It's all but done to be Trump's for the nominee, especially when you look at her home state where she's 20, 30 points behind the former president. Nevada was a little bit interesting because she ran on the primary and Trump's name was not on the primary. He's going to do the caucus, and it's pretty much all for him. But the optics of it are embarrassing.
Does she drop out before? Does she drop out? What are people saying to you in Washington?
Nikki Haley wants to go to her home state, and she will continue to fundraise until she gets to her home state of South Carolina. That's the one to look for.
Okay. Amory Hordan, thank you very much, keeping it real on the political front. Let's get some sector price action for you. It is an equity market show after all. Abigail Doolittle is with me. Politics and equities. What better can you ask for?
Absolutely. And the stock side of it, we're looking at gains for the S&P 500 up about 0.4%, up for a second day in a row. Most sectors are higher, so it is a broad-based gain. Communication services up about 0.7%, the best sector. Meta, the best stock in that sector. To the downside, though, real estate down 0.4%. And of course, you know, we have New York Community Bank Corp reopening. It had been halted, Manus, after all the volatility we were talking about before. It initially opened up down 10%. Now it's down 6%. So investors really uncertain. Now, it's interesting because if we take a look at the real estate index on the year, it is down 5% too. That's not a direct reflection of anything happening with NYCB. These are REITs and other, there's a lot of very solid companies in there, but just the fallout fear, the contagion fear taking this sector down, even though yields are much lower than they had been last year. So stay tuned on this one for sure, Manus.
Abby, thank you very much. Abigail Doolittle. Coming up in the show, market moving events to set your clock by. It is your trading diary on Bloomberg. There are no nerves in this equity market. You've got the Russell down by 0.6%. We're waiting for the biggest 10-year bond auction ever. So there are no nerves in the equity market for the big bond auction to come. We'll bring you those results with the tail, if there is one, a little bit later on. Set your agenda. This is Fed Speak Week, and it kicks off 11 a.m. today. We'll hear from Collins, Barkin, and Bowman. As I said, 42 billion of 10-year paper comes down the pike at 1 p.m. And Disney, a whole new world. The results will come after the closing bell. Thursday, Janet Yellen will speak again, testifying in the Senate. And Friday, it is about the CPI revisions. Right now, these equity markets are resilient. That was Countdown to the Open, and this is Bloomberg.
We're 30 minutes into the U.S. trading day on this Wednesday, February 7th. Here are the top stories we're following. Have and have-nots. Snap plunges and Ford soars as earnings season rolls on. We'll hit the biggest movers. The father of fast casual dining will speak to Panera founder and current Cava chairman about investing in the restaurant business in our Wall Street Week Daily segment. And in conversation with Carlyle, CEO Harvey Schwartz joins Sonali Basak in an exclusive interview 1 year on from taking the top spot. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at these markets right now. It's quiet. Once again, the S&P 500 currently up about 0.4%, slightly better if you take a look at big tech, currently up about 0.5% on that NASDAQ 100. I wanted to highlight the VIX there at the bottom, continuing to fall just slightly. And then we have New York Community Bank. Of course, that is one of the biggest stories in markets right now, falling another 7%. Just to give you an update here, the struggles are continuing. Of course, the lender was cut to junk by Moody's yesterday, just 1 week after announcing that it was slashing payouts and stockpiling reserves, putting more concern on commercial real estate. Joining us now is Herman Chan of Bloomberg Intelligence. Of course, we come to the news of this morning, Herman, and that's the fact that when you look at New York Community Bank, it actually said that deposits have increased since the end of last year. How much of a comfort should that be? Because I take a look at the shares and I'm not seeing much.
Yeah, it is a near-term comfort that they boosted liquidity and deposits actually grew despite the market turmoil in the shares. So that's something that is less of a near-term concern that deposits are flowing out of the bank. But what's more concerning after hearing their management call earlier this morning is that they're still focused on building capital, but they are also talking about shedding commercial real estate loans, which will pressure potential top-line revenues to be able to build that capital.
And of course, you weigh what we heard on the management call, and you put that against the fact that they have actually seen deposits increase. But I guess the question becomes, Herman, at what point does the tide turn? If it does, when do we start to see deposits leave?
Yeah, that's an open question. We've written about that a little bit, where they do have some larger CD funding that is set to expire over the next 3 months. So that's something that we'll be closely watching. But management seemed pretty encouraged by the fact that deposits have been really sticky, and that's proving to be a great asset in this current market turmoil.
And you take a look at the broader sector right now. I'm taking a look at KRE. Of course, it's the ETF that tracks these regional banks. It's down once again, currently off about 2.5% or so. How worried are you at this point about contagion risk?
Yeah, that's something I think the market's trying to suss out right now. I would say that the issues with New York Community are part idiosyncratic and part systemic, right? The idiosyncratic part is them building capital as a $100 billion asset institution, and they are a niche lender in the rent-regulated apartment space that they really dominate, so less repercussions for the rest of the industry. That being said, commercial real estate worries are front and center for the entire group, and there's going to be some lumpy performance in 2024 and beyond due to expected higher net charge-offs.
All right, Herman Chan, really appreciate your time and your insight. Of course, Herman Chan of Bloomberg Intelligence. And let's keep this conversation going now with Sarah Hunt, partner and chief market strategist over at Alpine Saxon Woods. And Sarah, let's talk about the systemic part of what Herman Chan was talking about just now. How concerned are you that this is the beginning of something broader when it comes to what we're seeing in the regional banks and what we're seeing when it comes to CRE?
I think you've started to see, so last year in March, right, we had this panic over this issue that was going on with Silicon Valley Bank. That was much more about the assets they were holding on their balance sheets in terms of treasuries and what had happened to that market. Right now, we're dealing with the fact that you have an asset class that is very much overvalued relative to where the current market is right now, both for rents and for occupancy. So how big does that become? People have argued about the size of the office commercial real estate market as opposed to other parts of commercial real estate, because government buildings, education, school, like all that is not going to be the problem. But the problem is going to be very acute in some very specific places, and that's going to be very difficult for lenders to overcome. I think the biggest issue this time is much more about destroying the profitability of the bank as opposed to the banks going under, but it depends on how big those haircuts have to be and what kind of assets they have to backstop in other situations.
And of course, it sounds like that's a story that we're going to be following for months here. But you talk about acute pain, sort of isolated issues almost. When you think about the broader market, do you see any risk that there's spillover beyond what we're seeing in the regional bank stocks?
Well, there's always a risk of spillover. It depends on where the fear of the general market is and what people are looking for. In September and October of last year, when the market was looking really shaky, the AI story came and sort of saved the equity space to have this great thing to hope for. If you have an equity market or investors that are looking for something negative to hang their hat on, this could be something that people can point to. The issue is that there's a lot of other things that aren't going as poorly, so it depends really on when and how badly this breaks and whether or not it starts to really knock banks down like dominoes, and if you get a larger effect. Right now, it's still a small, but it could be a butterfly. You just depends on the timing and depends on what else is going on.
Well, I'd love to talk a little bit more about the psychology of this market, because in addition to what we're watching play out with New York Community Bank, we also have earnings season rolling on, and it feels like it's really have and have-nots. It's been a really mixed bag so far, and you think about the sentiment in the market right now. Do you think that this is a market that is looking for that negative news story to really hang their hat on?
It doesn't look like it's looking for a negative. It feels like a market that wants to go higher, because even though the Fed has come out and sort of, you had mid-December last year where Chair Powell came out and basically said, look, we're pretty much done with this, and we think that the risks are now to the employment side, so we want to be careful. That gave the equity markets and the bond markets room to say, okay, I think the Fed cycle's done tightening. There was a lot of enthusiasm about that. Now you've had some pullback and pushback on that, and Kashkari came out recently and said, 2 or 3 as opposed to the market pricing in 6. So I think if the market wanted to be negative, it would take a look at where rates might stay and start to get fearful. It doesn't feel that way yet, but again, these things can turn, as we all know, on a dime, and at the moment, it doesn't look like it's looking for a fair moment.
Well, like you said, these things can turn on a dime. Of course, the memories of March 2023 are fresh in many people's minds. How are you feeling about it? Or do you feel the temptation to go into maybe some more safety plays, reach for some haven assets? How are you thinking about things?
So, given how much tech ran last year, we still like tech. It's hard to get away from tech, right? And the idea was at the end of the year that the Magnificent Seven weren't going to be driving this year, and then look what happens. You get some massive earnings outperformance from a couple of stocks, and those are still continuing to go. So what we're trying to do is make sure that we have a lot of other representation of companies and parts of the market that we like. So there are some areas that we're looking at. If rates are coming down, utilities are not as bad as they could be. If rates are coming down, there's some other opportunities in industrials and some other parts of the market. But at the same time, broken clock is right twice a day. I've been liking energy off and on for the last year or so. At the same time, what's driving the market right now is still a little bit on the momentum side. So that does favor some of the sectors that were already in favor.
Favoring some of the sectors that, again, were already in favor. That, like you said, sounds a lot like tech. When you think about what we learned, like you said, we had really stellar results from just a couple of names, not so much if you take a look at other areas within the Magnificent Seven. Is that enough to sustain this momentum?
Well, if it wasn't, you would have seen some of those stocks that didn't have fantastic earnings have a lot more negative reaction than they did. I think that for some of them it was good enough. For some of them it was much better. I think the world is going to be watching NVIDIA very closely when that reports earnings. But it's starting to look like, from what Microsoft and some of the others reported, that you're starting to see revenues hang on AI. And I think that was the biggest question, because if the answer to that had been none of those areas are actually generating revenue, they're just really exciting, then it would have been more of a problem. But I think that the way the stocks reacted, even if the news was, mediocre to okay, wasn't like a disaster. So I think that shows you that there's room for that to at least stay where it is, if not continue to expand.
All right, Sarah, stick with me, because we're going to be talking about healthcare and we're going to be talking about energy next. But let's take a quick look at what's moving underneath the surface of the markets right now. We're going to do that with Bloomberg's Abigail Doolittle.
Well, one stock that's moving in an interesting way, a volatile way, Katie, is Tesla. The shares had been higher earlier, now lower. And this, of course, after Tesla seems to be getting philosophical. According to sources that want to be kept private, Elon Musk, who's, of course, known for his work hard ethics, he has asked his managers to basically say yes or no on their employees. Are they critical or not? Now, as for the reason, because that's a pretty extreme way to look at things, their headcount has doubled since 2020, 8 times since 2016, and this, of course, as revenues have stalled to about 1%, up 1% in the last quarter, versus many, many quarters of up more than 40%, Katie. Plus, profits, they were down last year, I believe, 29%, actually, and so that's one reason.
I really don't know how you would answer that question other than, yes, I am essential. Yes, I am very productive. That's a really interesting one. We'll see how that manifests, whether it does mean layoffs. But what else you got?
Well, Snap is having a really rough day, the worst day since July of 2022, and on the surface, it's about the revenue miss. Beneath the surface, it has to do with the fact that earnings falling for a third year in a row. They, of course, have made workforce adjustments, even one this week. Now, this week's wouldn't flow to the bottom line, but last year's, I think investors were looking for that, plus revenues, a small miss there, having to do with ad spend going elsewhere. Ad pricing down 2%. Plus, Katie, if you take a look at active users, they did grow 10%, but that was really North America and Europe. In the other areas of the world, not as impressive. Investors want more. Snap at this point, wow, catch a falling knife, also a true show me story.
Yeah, that is a biblical move lower when it comes to those Snap shares, and I think that's going to be a really interesting conversation to follow as we start to see some of the other social media companies report that ad spend, of course. It seems like a lot of existential questions that need to be answered, but I know you have a retailer on the board. Tell me about VF Corp.
Well, VF Corp, this is another one that's a bit of a disaster. Some are saying that this quarter was much worse than feared. When you say that, given the fact that into today, the stock from its peak down 85%, that's a really bad quarter. They put up a big earnings miss. Sales were supposed to be above $3 billion, below $3 billion. Another catch a falling knife here. Because it's in such a world of pain, only the worst day since November or October of last year. Management not willing to give a detailed outlook. Apparently it's the North Face brand that's really a problem. The CEO management also said that they are evaluating strategic growth options for the various segments. So it's going to be interesting to see what they do if they try to sell some of those brands or if they make changes, some sort of a restructuring. But another, let's call this a turnaround story.
Yeah, a great earnings season so far. For some, pretty punishing when it comes to others. Bloomberg's Abigail Doolittle, great to see you. Coming up, a touchdown for sports fans. Disney, Fox, and Warner Brothers are teaming up to create a sports streaming powerhouse. We'll take a look at the deal next. This is Bloomberg. Well, some huge news last night. That, of course, is media powerhouses Disney, Fox, and Warner Brothers teaming up to launch a new sports streaming service this fall. Let's get some insight now from Geetha Ranganathan, Bloomberg Intelligence Media Analyst. I mean, just to start, set the scene for us. I was pretty surprised by this. Were you surprised? What are you making of this?
Yeah, definitely a surprising move. I mean, we knew all along, Katie, that ESPN had something in the works in terms of going over the top with a streaming service, but we didn't really expect to see kind of big media band together like this. I think it's really a good move for these companies, and it will be incrementally positive for them. I mean, this is big media kind of finally standing up to the tech companies, to Amazon, to Apple, to Netflix, which have all gotten really aggressive in terms of sports rights. And it's kind of media companies taking control of their own futures, right? They obviously have always controlled content production, but now they will control distribution as well.
And I want to talk about what this means for cable. Of course, that is the question on everyone's minds right now. You take a look at Charter, for example, down by almost 2% this morning. It feels like one of the rallying cries for why cable still makes sense is that you still have live sports, but what does the future look like now?
Yeah, that is definitely the big question, and I think, you know, we'll only probably get more answers once we know what the price of this new service is going to be. I mean, they have to be very, very careful to price it at a point where they don't cannibalize, you know, their existing revenues from the linear TV bundle, because if you look at Fox, if you look at, you know, Warner Brothers, Disney, they're all very heavily exposed, getting almost, you know, in the case of Fox, it gets almost 80% of its revenues or even more from the pay TV bundle. So obviously they don't want to cannibalize themselves. Again, they'll have to price it attractively so that it does appeal to the hardcore sports fans, but at the same time not kind of jeopardize their own future with the linear TV bundle. So pricing, of course, is going to be key. The rumored price point is somewhere in the $40 to $50 range, but we'll have to wait and watch.
Yeah, fascinating to see what pricing actually shakes up like. But of course, the news continues to roll on because we just got these headlines a couple of minutes ago that Netflix is greenlighting 2 projects with the Boston Red Sox that they're going to follow an MLB team over the course of a full season. You did see Netflix share pop on the back of that news, and it really feels like this just folds into this conversation that we're having about how media is handling sports.
Yeah, I mean, I think, again, yes, absolutely. I mean, this is perfect because this is exactly what the big media companies are kind of fearing, right? You see Netflix, they went after that WWE Raw content with paying $5 billion over 10 years. You see these new deals, you know, sports documentaries, more and more sports content as they kind of try to build out their advertising tier. And so it kind of makes sense that I think the media companies band together and really kind of, it's a really good defensive strategic move as the big tech players kind of try to get into their space.
All right, Geetha, really appreciate the instant analysis. As always, that is Geetha Ranganathan of Bloomberg Intelligence. And let's welcome back now Sarah Hunt. She is partner and chief market strategist over at Alpine Saxon Wood. So we talked about earnings, we talked about tech. I want to talk about healthcare because I'm looking through your notes and you mentioned that there are opportunities in healthcare. And when I think healthcare right now, I think weight loss drugs. Is that the proper reaction, though? Is that what you're looking at, those GLP-1 opportunities, or is there room to grow beyond that?
I think there's a variety of different answers to that, right? So I think that the GLP-1s, you can't ignore them. There are discussions about how some of those medications on the longer term can change the face of healthcare in a lot of ways. So I think part of it is navigating both how that fits into the system currently and how it might fit into the system in the future. But you're still going to have a variety of other healthcare issues that are not going away, right? You have an aging demographic, you have all sorts of other types of health issues that are not addressed by these. So I think that there is opportunity in the space, but it's definitely one where you have to be careful about how you're navigating it and what you're looking at and whether or not any of those big drug movements can make a change in something else that you don't realize has an ancillary effect.
Yeah, and it's interesting. I mean, you look at the sector, and it's not that weight loss drugs are disrupting retail, et cetera. It's also disrupting healthcare because you saw a lot of stocks within healthcare actually have pretty terrible year last year on the heels of that. But I'm curious, when it comes to healthcare, the conversations that I have, sometimes people highlight that they see potential M&A opportunities there, that it's an industry that's ripe for consolidation. Is that part of your call at all?
I think it has to be, because if you look at what happened over the last 5 years, I mean, we'll include now, we're in 2024, up into the pandemic, you had such a disruption in the healthcare system, both in its delivery and its utilization and what was happening. You had a lot of people put off a lot of things so that because they didn't want to go to a hospital or didn't want to go see a doctor. We're still not through that, right? That's still an issue, which is why I think it's been very difficult to gauge healthcare earnings ahead of time. I think that some of the insurers may have some issues going forward because you had basically a lack of utilization for a couple of years. It's a market that has a lot of disruption, but also is very important, which means that always within that, there should be opportunities, and I think that there will be M&A within that space.
Well, on the topic of overlooked opportunities, let's talk about energy. I brought this stat up on yesterday's show show. I'm a little bit obsessed with it. You take a look at Chevron, for example, record production in 2023, bought back 5% of its stock, and looking forward, it has some pretty rosy projections as well. But you look at energy and Chevron overall, and the valuations that we're talking about are well below that of the broader S&P 500. How are you thinking about energy in this market?
So this has also changed a lot. And the thing about energy is that it doesn't matter until it matters. People either ignore it or it gets a smaller part of the S&P when things are either not going well enough or other things are more important. And there's a steady stream of production, right? So you have big moves in energy when there's disruptions in the supply side. And right now, again, you have another 3 or 4 years behind us of very uneven demand and supply, but a much higher supply than people anticipated, partially because a lot of the sanctions didn't really work. A lot of that production did not, in fact, go away. So you still have an excess of supply, which means that people are basically ignoring the space, and there's this assumption that we're going to go from hydrocarbons directly to other types of energy without really building in the fact that the physics take longer than that to play out. So there's this idea that the market is going to come to an end sometime in the near term, whereas we think that there's a longer tail. So you have to trade around positions and look at things that you like. There's been a huge change in capital allocation in the industry. You're much more likely to see buybacks and dividends than you used to be. So I think that there's room in there, but then you've got a wild card like this LNG issue that the administration just put out, and then that also can disrupt the space.
Right, and I mean the point on supply is so important because even with all of the geopolitical issues that we've been talking about for the past 2 years or so, you really haven't seen anything be able to overwhelm that supply story. And I'm looking through your notes, and you make the point that the lack of longer-term investment will constrain supply. We're not there yet. What timeline are you looking at for that?
So I would have thought that we would have been there sooner, but I think the fact that you had so much U.S. onshore production that was much easier to turn on and turn off, because historically speaking, most of the production was not onshore, at least in the U.S. It was offshore, and those were longer lead time projects. In the U.S., you had so much backlog of drilling that was able to be done that the minute there was any sort of issue with supply, everybody was looking at higher oil prices and going, I've got room to do this, and they were allowed the capital to do it, because for years there was this sort of wildcat atmosphere about oil production where you could get capital whenever you had a project, and then that got reined back in. But at higher oil prices opened up a lot of that production in the U.S., and I think that was a surprise to a lot of people.
Absolutely. Yeah, the U.S. becoming really a powerhouse, too, when it comes to energy production. I don't know how many people had that on their bingo card. So we talked about tech, we talked about healthcare, we talked about energy. Where are you avoiding right now?
Well, I think that some of the areas that you have to be a little bit careful about, one is a valuation situation. So even though we like tech, you have to be a little bit wary of some of those valuations. We like the semiconductor space, but some of that stuff has run a lot. And so I think that there are places where you want to be a little bit careful. And even in places that we like energy, you need to be mindful of the fact that this could be, again, something you want to trade around. You want to make sure you're getting paid to wait, so you've got a good dividend, you've got some buyback and some company support there. I think that there are areas where, it's hard. Retail's been very difficult to piece out. Everyone is changing some strategies here and there. Amazon is still taking share. There are some places you just need to be careful. It's not so much avoiding a sector completely.
Yeah, it definitely feels like a trend shift, a sea change that is going on in retail right now. Sarah, really enjoyed this conversation. That, of course, is Sarah Hunt of Alpine Saxon Woods. And later today, on the note of healthcare, I'll be speaking with the CEO of Novo Nordisk. That's at 12:30 p.m. New York time. Now, still ahead, though, on this program, we'll take a look at the companies making the most social buzz today. Social Climbers is up next. This is Bloomberg. All right, time now for Social Climbers. Look at the stocks making waves on social media this morning. And first up, Alibaba out with earnings today that fell short of estimates. China's e-commerce pioneer says it cut about 20,000 employees throughout 2023. Next, we have Chipotle beating fourth quarter sales and profit estimates thanks to strong sales. The burrito chain bucking the trends that we've seen from McDonald's and Starbucks. And finally, we have Ford soundly beating expectations and forecasting higher profits this year. The automaker is scaling back EV spending and dialing up output of its gas-fueled models. That is a sign of the times. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now coming up, the Carlyle Group overhauling how it pays deal makers to free up cash flows as it plans a $1.4 billion share buyback. We speak exclusively to the company's CEO next. This is Bloomberg.
Great questions.
Welcome to our Bloomberg television and radio audiences. I'm sitting here with an exclusive interview in Washington, D.C. at Carlyle's headquarters with the CEO of Carlyle, Harvey Schwartz, in his first interview since joining a year ago as CEO. Harvey, today you announced a number of strategic updates to investors. Your stock is up, the most it's been since 2022. What is the biggest change that investors need to know about the future of Carlyle today?
So great to see you, Shonali. I think the movement in the stock, which you point out, is much more about seeing the momentum in the franchise. So coming into the fourth quarter, the team really came together, and whether it was record FRE, fundraising, the momentum coming into 2024. And then, of course, on the call, we outlined some strategic initiatives and, for the first time, financial targets for 2024, which, have very significant upward trajectory.
We'll talk about those initiatives, but we can also say you passed your first year on the job. The grace period is over. What's the biggest...
It was my anniversary yesterday.
Yeah, and what is now, you're looking into year 2, and a lot of people think of this as a make or break year. What is the biggest challenge for you as you enter this year?
So 2023, as a new CEO coming in, it really was about investing time with my teams and spending time with our investing clients around the world. I think I met with over 300 LPs in the first year that I was here. And with respect to my teams, it was really about me getting to know them, but more importantly, them getting to know me. 2024 is really about focus on our priorities, excellence of execution,